Oh, I see.
charts, which we're gonna actually start to. We're going to start in our mid-year report for our commodity report. We're actually
Oh,
ready to publish this in a few days' time. So we'll have a bit of a preview
okay.
on the inflation pop theme,
All
where
right.
we are in the cycle of it, because
Okay.
so
I
we'll
liked it.
we'll have a look at that, I think, to start
Okay.
with.
Let's start.
Yeah.
Hello, everybody. We have a treat today. One of the best Ellioticians I know, and I've interviewed dozens and dozens of people that use the method of Elliott wave theory to forecast and trade. And today we're joined by Peter Goodburn. Peter, welcome. It's your a return visit to TradeGate Hub. Welcome. Thank you for being with
Yeah.
our community today.
Great. Thanks for inviting me, Dale. It's a pleasure. Thanks.
So, Peter, how long have I been interviewing you? I think it goes back to when I was on FX Street. So, be over 4 years in my guesstimate.
Yeah, it has been, and I think to some extent it
40.
feels like longer. I don't. I'm not sure whether that's a good or bad thing, but
Yes, it always feels like longer when people spend time with me. Anyway, Peter, I remember when we first spoke and S&Ps were trading sub 2000, I think in the 1800s. And, I'm used to hearing, aggressive narratives on the market. In fact, at times I call myself Noster Pinkert because I'm making these long-term calls. And the first interview, you had a target when we were sub 2000 of 4,200. It was in the S&P. It was the most aggressive target by using any method, Elliott's, harmonic, whatever you use. You're one of the few that were talking 4,200. Had a lot talking 3,200, and I came away from that interview with my eyes open that that Peter's looking for something like this. This would be a tremendous move to be achieved, and we achieved it this year. But before we get to what's happening today with some risk off coming into the market in a really in a strong way, I'd like to take you back to your genesis in your career and what you were doing prior and maybe your first few experiences in the industry. Why don't you tell us how it all began for you?
well, yeah, okay. Well, I was first inducted into trading back in 1977, which seems like an age and a half ago, because I left college, and I was a friend of mine was working in the commodities business. Now, back then, commodities was the big thing.
Yeah.
The bond markets didn't start trading until 1982. And up until that time, there were, of course, equity markets, and that was a main focus. But commodities was a really big thing in the late 70s. And of course, we started to break through from Bretton Woods and the gold standard a bit earlier than that. And commodities were already taking a resurgence. And so when I started trading, I was working for one of the big mining companies, which was Billiton, and you've probably heard that name.
BHP.
Um,
Yeah.
yeah, and they were probably there was one of two largest brokers on the London Metal Exchange. And of course, we were trading on the pit, so we were going down and trading every day, and I was down there every day, twice a day, coming back to the office during the breaks and talking to clients then, and that's how it really began. So I think my overall interest in Elliott Wave came about because one of my tasks as a junior trader then was to make sure that everybody was pretty much up on the news flows first thing in the morning. So I would be the first in the office, take the ticker tape, tear off all the relevant bits, read it all, photocopy it, and then put it in everybody's desk. So the senior traders would have it straight away, and then they could get off and trade. And it wasn't too long before you saw the discorrelation between fundamental news flows and what the price action does. Doesn't matter whether it was on a long-term or a short-term basis, really, but you could see that the markets weren't logical. And I joined London's Society of Technical Analysts, I think, pretty much when they were they were born from the old preview technical analysis organization that it was, and started getting interested to see if I could find out a bit more about what's really driving behind the trends. And then I learned about a guy in London who was on London Broadcasting Radio called Bob Beckman. He was doing Elliott Wave and wrote a book called Super Timing in the 70s.
Okay.
And I read that. And then, of course, later, I was introduced to people like Bob Prechter and his work.
Okay.
And that sort of ignited my interest. And I think from there on, I pretty much was taking it literally and using it on a daily basis.
Okay. All right. Now no, go ahead, Peter.
Yeah, and just from that time on, really that sort of helped to explain to me, or at least put price patterns into perspective. And actually, one of the big situations that have arisen recently is, of course, this big idea of the reflation trade, which has gripped the market since the pandemic lows last year.
Right.
And just recently, this week, the way that Treasury yields have been declining very rapidly because we've up until now seen the reflation trade and the market's belief in that reflation trade is still unfolding, but actually it's not. It's taking a big pause, and we'll come to that in a short while. So this is the dichotomy between fundamental research and technical analysis like Elliott Wave. It can be very, very helpful for everyone to figure out where we are in that perspective.
Okay, well, I've interviewed many Elliottian practitioners, and they always have alternate counts, and different Elliott practitioners could have completely opposite views on the market. And I'm wondering what separates your Elliott Wave style from most that have also read, Prechter and Frost's book on Elliott Wave, and then took it from there. Have I know that you do things with that are fairly esoteric to most people, like Fibonacci and time, and you've been developing and fine-tuning your work to give roadmaps like this to people. What separates you from the others, Peter?
Well, I think simplicity, not necessarily complexity. Keeping it relatively simple. I think the Elliott Wave construct isn't without fault or error. That's one thing to acknowledge. And you can learn Elliott Wave pretty thoroughly. You can still make errors. It's not necessarily an application error that anyone can make. That can be purely because the data point at any given part of the analysis could be misinterpreted, mainly because the data point isn't very clear. I mean, not all movements up and down are very clear Elliott patterns, and some of them can be very ambiguous. You've only got to have one in a small sequence, and that can throw you off. The way to try and...
So it's ever changing, like all types of analysis. As price action continues, counts change, targets change, and it's an ongoing process. But there are some times where, nothing changes when your counts, I've seen them, like your call of Bitcoin from 3,000 a year ago.
Well, I think the markets are malleable. They are moving, of course, but at some stage you have to take a stance. I think the way that we try and eradicate sort of error in the data point itself is by doing a lot of cross correlation work. So when we take a look at maybe an equity or a stock index, we're comparing maybe that equity in the sector that it's in, whether what the underlying market might be doing. If you've got a peripheral equity, what is the most traded? What is the biggest equity market weighting doing? Is that a clue? You'll always get some sort of slight pattern differences. For example, one similarly corresponding equity might be involved in a zigzag correction, and another one might be involved in a flat. Yes. But that cross correlation is really good, because then you have a pretty concise idea that when those two will end and when the reverse of the trend will occur. It's the same thing as also being thorough with everything that you do. If you put your mind to it, you can achieve some great results. And eventually, if you do cross correlate, that eliminates a lot of error, particularly because you might get one equity, for example, or one stock index, which doesn't have that ambiguity in that particular precision point, which you may see in the other.
Okay,
The other
well,
thing,
you were talking about correlations, and I read your work, and I do my own analysis, and I have my own views. And something that you've been writing about for quite some time has been the Russell not making any upward progress since its high in March. So I've been watching that, and I know the technicals. I talked about. I made jokes, Peter, that people had a chance to buy the breakout in the Russell about a month ago, 10 times, and even were able to buy the Russell underneath the breakout. That's how nice Mr. Market was accommodating people. And it looks like the bears are starting to gain control here. Is this the first domino? And I've asked people, and I know you're mainly a technician, but what does this say about the Russell 2000, which is mainly domestic issues, doesn't really benefit from a weaker dollar like the multinationals do? What does it say about an index that's been moving sideways for 6 months with what was supposed to be a burst of economic activity that was going to give the U.S. a 10% GDP number after the reopening? Is the Russell saying that the U.S. economy isn't as strong as, say, for example, if that's your audience, those are your consumers, you're better off having the whole globe like multinationals? How do you explain the Russell not making progress for 4 months and now rolling over?
well, I mean, the fact is that we've got unprecedented amount of liquidity being pumped into the financial system from the central banks. And it's quite, I think it doesn't take a lot of reasoning to figure out where the money's going to go. It's going to go to the major corporates, isn't it? And don't forget the Russell is really representative of the small caps.
Right.
They're more domestic orientated, but the amount of unprecedented fiscal and monetary stimulus that's coming through is really going to benefit the large caps completely. I mean, there's no doubt that they have access to that type of banking facility,
Okay.
which is going to filter through to them. And in a global export market, that's very, very significant. So the more nationalized corporates, the small guys who are the constituents of the Russell.
Yeah, so the
are going to benefit so much.
transnationals of every country do better because the central banks are behind them rather than the national economy of any country.
Yeah, absolutely. And
Okay.
it's always the case that the small guy takes the brunt, isn't it? And
Yeah.
the big guys, the fat cats, get wealthier. And I think that's a very significant aspect to here. I mean, if you look at the way that the Russell up here, we've topped out in March.
Right.
So we're pretty much 3 months in, and we have made no progress whatsoever. And this is a bearish indication. I mean, of course, if you go back to Dow theory and you start looking at the way that Dow theory works in very simple terms, all it is a bearish divergence or a bullish divergence, isn't
Right.
it? I mean,
Yes.
you're looking at comparing between the Dow Industrials and the Dow in utilities or the Dow transportation average, and you look for divergences. And if one is not making higher highs and the other one is diverging and is down below those previous highs, at some stage you're going to see a directional change to the downside. Now the question is it a good timing indicator? Probably not. I mean, if you sit here and wait for 3 months, you're missing a lot of action in the outperformers. But overall, this was always a very key significant signal. Let's just I'm just going to expand this window a little bit, because on the left-hand side, you can see that the top in March at 2366 produced what we call an Elliott wave 5-wave impulse decline.
Okay.
Into that March low at 2092. Now, of course, that 5-wave pattern means that any subsequent correction will not break that previous high. It must indicate that the trend is down. And of course, we've had 3 or 4 attempts to break that high, and it never could. And of course, that's where Elliott is such a benefit in using and applying this method, because you have a pretty good idea that this is not going to make a higher high. Here's one attempt, here's a second, here's a third, and here's a fourth. And here we are starting to accelerate, and breaking below the mid-June low here now today is really quite significant. That's really on a roll. So I think we've got an accelerated third wave now in this progress. So that's going to mean that we're going to see a lot more downside potential coming through. And I should imagine that that will be probably too much for the large caps to hold up from as well now. I think they will also buckle to the downside pressure. If we take a look at let's have a look at the, this is the S&P. Yeah, it's, now this movement up is the final stage of the larger picture that we've seen. And it goes back to May's low here at 1429. Now this pattern is called an ending expanding diagonal. It's composed of 5 waves. So you've got 1, 2, 3, 4, 5. And yeah, people call it a sort of like a megaphone. Opening up.
Yeah.
But it's composed of 5 waves. The important thing really to help diagnose what this is really is that the subdivisions in the impulse waves 1, 3, and 5 should all be zigzags or multiples. By that I mean sort of double zigzags or triples, which this does conform to. And if we extend 1 to 3 by 38%, we get a target of 43.49. So we've been ipping and nibbing at that. And finally, we've started to get price rejection. And here it is in the bigger picture. So what we've just been looking at is this one. And that itself is a 5th wave from March's low. And March's low is a 5th wave from September's low. So we're finishing from September 3 degrees of trend up here. And that augurs really a very, very bearish outlook for the next several months. Now, we come to a very much more important point now, because this sequence from September is 5 waves up. But when we go back to last year's lows, here we are.
The end of COVID.
March.
Yeah.
Yeah, this is the pandemic low.
Right.
We've only got 3 waves up in the larger sphere. So we've gone 5 waves up into early September. Here's the correction in late September, and then the 5-wave pattern we just looked at. And that means that you've got, in principle, 3 larger degree waves up from the low. Now, if you're starting an uptrend, as we did from the pandemic low, that uptrend ordinarily should be unfolding into 5 waves. But we've got 3 waves, very distinctly 3 waves up. Now, there's only one reason why an uptrend will contain 3 waves like this. It's a zigzag. And that's if it's part of a larger 5-wave pattern, which becomes a diagonal. And if I just roll back a little bit here to the weekly chart and go back to the pandemic low, which I'm pointing to now, wow, you'll see that we've got this diagonal in play, because the first wave of an ending diagonal, again, is a zigzag, just like we've seen in the micro sense here, in the expanding diagonal that we've seen since late May. So the real problem here is that we're going to see a big unwinding of the reflation trade. We've had the reflation trade now right the way through from at least September onwards. That's certainly when the markets awakened to the fact that the pandemic low was an established uptrend. Don't forget, up until August, September last year, major institutions were still thinking about a double bottom in the markets.
Yeah, no, we never had one good break all the way up from the COVID low. I kept waiting for it. I'm sure I wasn't alone. And then this grind, you had divergences all the way up. So top picking has also been dangerous. And, you've had your 3 to 5% pullbacks, but nothing like what you're expecting here, Peter. That you said something about a signature reversal. Give me the definition of a signature reversal.
Well, yeah, I mean, a key reversal signature is basically a term that I came up with. It's pretty basic. Again, you can go through normal technical analysis textbooks, like a key reversal, higher than previous day's high, lower than previous day's low, finishing on the low of the day. That's a classic one. For those of you who are prefer to use candles rather than a line and bar chart like I do, you've got your candles reversals there too. The main thing is to really wait and see if you get a big outside trading day and a finish near the low. I mean, that's a pretty
Yeah.
classic reversal signature.
Okay.
And we're probably due for that today, especially if the cash indices start to catch up with what the futures have done overnight.
Yeah, I
I
know.
was
I
just going to
looked at
show
the
you.
weekly. I think it's about 42.74 was last week's low. We could have an outside week to the downside with a day left.
That's
So,
right.
okay.
Yeah, we could with tomorrow just as the last day of the week, if we get more declines, and the Russell certainly looks like we're picking up some downside deceleration, then we could see that. This diagonal though is very important. I just want everybody to understand the implications of why that's forecast down here, because if we have gone up in a 3 price swing event from the pandemic low to today, then that has to be wave 1 of an ending type diagonal. And because of the upside target, the ultimate upside target is 5,400. And that's derived very simply by a sequence of fib price ratios. Now I'm going to show you how that's done first. We just measure up like this from the financial crisis lows. We go right the way through to the top of wave 3 in 2018. And we just add that. And you can see the 61.8 line is drawn to 5,400. So we've gone up quite a bit since pandemic low. In fact, we've gone up 3/4 of what we could expect to see in the entirety of that bull market period. Right. But the timing isn't correct. I have to say that some of our work is cycle work, and we've actually already published our part 1 video series for mid-year reports. If anybody's interested, I can tell you towards the end of today, but that explains the cycles will not top the markets out until we get to around 2023 latest, or the earliest, I should say, and 2024 maybe the latest. So the timing's not right for, I mean, if you were to extrapolate this on a simple line curve like this, the bull market would be over by February, March next year, but that's not going to happen, I don't think. I think we're going to get a very sizable decline because this is a 3-wave pattern, not a 5. Now, the typical diagonal on this looks a bit like this. I'm just going into our wave search program, and if we put in a diagonal, an ending type diagonal, it looks a bit like this. But the second wave is very deep. It has to be very deep because otherwise, let's put in some ratios. 76. It's typically a 76% retracement.
Okay.
And this is very, very important to understand. And this is why we think that the markets could drop 30 to 40% over the next 6-month period. You can see that the first wave is a zigzag. Look, A, B, C.
Right.
And so we're just basically following the guidance of Elliott through this sequence. And that's why we think that the markets could drop quite a bit.
Okay. Well, Peter, I've been talking about all one market. It seems that since the COVID low, and you're talking about, the reflation trade, you had S&Ps go up, you had precious metals go up, you had commodities go up, you had crypto go up, you had the dollar going down, that it's all one market. And I look at the dollar as being the fulcrum for the other instruments being the spokes attached to the fulcrum being the dollar. And while the dollar was weakening, air went into the balloon to reflate it. And when the dollar is in a bull stage or even a sharp bear market rally, air comes out of the balloon of that reflation. And I think that's part of what you think is going to be behind this bear move in equities is a bear market rally in the dollar.
Yeah, that's right. I mean, actually, when we wind the clock back to January, that was when the dollar index bottomed here at 89.21. We actually thought the stock market was already starting to look a bit top heavy. And of course, then we got some sort of regression here. And then finally, the dollar started to really put on some upside acceleration, which is what we originally expected. Now, the fact is that the dollar's been a rather sort of deep correction from this late March into early May.
Yeah, it turned on the Fed. You were expecting a marginal new low underneath 89.21. I was as well. I thought we'd, get to that 88.5 level. So how do you turn when a scenario does not unfold and the turn happens before it gets to a level that you thought it would get to?
How do we adjust, you mean?
Yeah, because
Um,
that's the business.
well, I mean, we were aware of the possibilities. Actually, it's an interesting course of this because originally we did have this exact pattern as a double zigzag. For those of you
Okay.
familiar with Elliott, we have A, B, C, X, and then A, B, C. In fact, X, we started to get a bit nervous about it because if you look at the the inset chart at the top, if you were to extend wave A down by 61.8, you would break the 89.21 low slightly. So we thought, yeah, that's probably going to happen before it swings next back up. That would have changed the double zigzag, which you see on the screen here, into an expanding flat. So you get a slightly lower low, and then you move up in 5 ways and get to 96.15. The fact that it came on in a very abrupt way was really because of that Fed news. Suddenly, the Fed changed their whole policy around and went from dovish to hawkish. And suddenly the dollar jumps up. So as soon as we saw that, we had to backtrack and saying, right, well, we can't expect to see that lower low. We'll just have to go back to what we had before. But the larger picture really hasn't changed at all since January, and that is that we had a complete 5-way pattern down from the pandemic high into January's low, and that we're going to spend most of this year sort of trending upwards into a correction. And so that really hasn't changed at all. And then you can use that sort of knowledge around looking any other cross or pair within the dollar realm. But there's
Okay.
not been too much change, actually. I think probably one of the standout issues on the currencies over the last months has really been the Canadian dollar because of what oil's been doing.
Right. I was just going to bring up oil, but I wanted to have you take the other side of dollar bulls. I know you're looking for a rally 96.15 or so, and then down to new lows, and you have much lower targets in the dollar. Some dollar bulls are saying that we have like some type of flat from the lows on the weekly that we had at 88.5, and the recent lows. I think those lows were a couple years ago. So it would be on a weekly, and they think it sets the stage for a rally much above 96 on a weekly chart.
Okay.
Do you have a weekly on the dollar here? I could
Yeah,
show you
sure.
what I'm.
Let's have a look. I think you'll find that.
I want to hear you refute it and why it's not what they're labeling it. So
Okay. Well, I'm interpreting what they're saying a
uh,
little bit. So let's have a look
I
at.
threw you a curveball.
Yeah, that's okay.
Okay.
I like curveballs.
All right. Yeah. Sometimes you just wait on those,
Yeah, I do.
and they hang, and then you hit it out of the park. Okay. So
Well, we're looking at the bigger picture here.
yeah.
Maybe what I should also show is a couple of cycles on the dollar.
Okay, well, I mean, the last two lows, it looks like October, the last two lows looks like a double bottom, and we
Yeah,
have a double top. And they're calling that just a corrective pattern. The whole sideways movement we've had from
yeah,
88, and that we're headed much higher. Yeah.
yeah. No, I don't. I think that's pretty unlikely. Admittedly, we've got some up moves still to come for the dollar index, but the problem is that the big accounts are already finished. There's practically little chance that you'll get back above the COVID highs.
Okay.
And even less a chance to go above the 103.82. The reason being is that if you go back to pre-financial crisis, when the dollar started to push up here, if you go up to here and extend that by 61.8, I'm just going to double click and it will project where the 61.8 area. That will tell you where the termination of the dollar's upswing will complete. So let's do that, and there you see it.
Okay.
So you've come into an exact top at 103.82. And this is trending down. This is basically a first wave, and this is a second. We're going to see a very substantial decline in the dollar, and that's really part of the inflation pop idea, which is a term I coined back in 2011, which really was to say that we've got a very strong disparative between what the stock market's doing and what commodity markets are doing. Commodity markets were already going through their the end of the super cycle. Commodity peaks were all back in pre-financial crisis highs. And what you've seen since on commodities, to a large extent, really defined as things like copper prices
Yep.
and some of the other base metals, is the beginning of a long-term deflationary era. So you've had a major collapse in commodity prices during the financial crisis. But since the financial crisis lows, you're going through a temporary inflation pop.
Right.
And that's unfolding into a corrective pattern, which is ultimately going to make new record highs. Even the commodities should make new record highs. A lot of them should. Not necessarily oil, but that's a bit of a complex one. But certainly the base metals and many other commodities will make higher highs before the inflation pop bubble bursts, which again is going to be correlated to the cycle peaks that we've got in 2023-24, and the stock market peaks at that time. And then you'll go through the next deflationary cycle. But you've got a lot more upside to come, and I think that's going to be the dollar's decline here.
Okay.
So I think by and large, no, I think it's unlikely that you'll scratch anything up to a higher high. This is the dollar cycle for the remainder of this year. So we peak basically in October. This isn't meant to show, by the way, a price target. It's meant to show direction and the timing of the trend change.
Okay.
So the direction changed in January. It was already telling us the dollar's going to work its way up until October this year. And that's the direction and the timing for that. So
all right, you know what would be controversial is, you finally have everyone convinced that oil's a great place to be, and I know that it's been relentless, and we had this high on an OPEC meeting. I believe it was Tuesday night. And we've come off pretty good. So you're talking about a break in this reflation trade, just a little bit of it subsiding, which means most markets are going to head lower. Biggest drop looks like equities are the most vulnerable, but you also have a fairly significant high happening here in the oil market.
Yeah, I'm just looking at Brent because we're just updating that for our mid-year report, and this one certainly looks as if it's getting ready for a big splurge down to about $46, maybe a bit more, in fact. This decline into the pandemic low, I have to say, was a generational low. I mean, as you know, for WTI, we traded down to 650 on the June expiry contract for last year. The May contract, if you remember, underwent that sort of, that went through that long liquidation where we saw minus $40. But that's I think if you've got the ability to scrub that off your charts, then do so, because it's a bit of an aberration. So
the oil sector, which people have been gravitating to in oil shares right now, Peter, they've taken it on the chin this week. They're probably in a void for a while. And it's ironic because they're just being embraced now after this huge rally from last spring.
Well, that's right, and this is why I think there's going to be a pause in the reflation trade, because we've got some major institutional clients on our books, and they're still even now talking about continued price activity to the
$100 crude. Everyone's talking about it now.
Yeah,
it's a layup.
And it's only been this week that suddenly I get a glimpse where people have started to doubt themselves. Some of the big asset managers have started to rethink. And that's, of course, been reflected in the big declines in treasury yields this week. So, there's certainly that moment has suddenly a point of realization has suddenly come about where the big fund managers who are controlling the big amount of funds are suddenly realizing they've got it wrong, that the reflation trade is taking a pause. And that's why I think we're starting to get some downside pressure coming in on the equities. We're starting to see some of the commodities start to turn down. And to be honest, we're already seeing early signs of that. The Russell we opened up with today, you saw that. But we also saw the banking index stocks start to ease off.
They don't like lower yields, especially if the curve's flattening, right, Peter?
Absolutely, that means less money to make on their interest rate loans. So you want a nice steep curve for the banks to go up. If you start seeing the 10-year treasuries drop as much as they have, start looking at the banks, and the bank stocks have come off, particularly in Europe, I have to say, and they look pretty weak. We've got sell signals everywhere on those at the moment, and we've been very bullish of those in the past, but we recognize that they need a pause. And the other thing, I think to reconcile with is that, funny enough, today we're just putting in some really great long-term charts on food products. And now we don't normally get involved too much on the agricultural scene, but I like to take a look at it from a distance. Let's put it that way.
Yeah, the
And
grains, they all had tremendous runs and have been in corrective process. Like lumber has come off quite a bit.
well, lumber has.
Yeah.
This is a chart from this is
Oh,
data
wheat.
from the Food and Agriculture
Okay.
Organization. They're based in Rome,
Okay.
and this data goes back to the 60s. We actually published this last year to show that the reflation pop was basically ready to burst higher, because we could see this pattern here was a typical flat pattern in Elliott terms, and that this was trending up in a fifth wave. And we had an enormous amount of price activity to come up. I mean, if you're down here at 85 and you're going to 195, then you've got, more than doubling of the price action in food prices. Now, this is wheat, coarse grains, and you can see the list here. If we go to the next chart, you'll see that this is the ETF that you can trade, the PowerShares DBA Agricultural Fund.
Yeah.
And this declined from the financial crisis high into a nice zigzag pattern. And we've got a big X wave coming in the next few years. Now, this is no way near completing in the in the inflation pop era. Again, we don't expect to see a major peak until 2023, 24 at the very earliest. So we've got a bit of downside price pressure coming, like most things, and the food sector's coming to the downside. And this will eventually push up. And you mentioned lumber, which is something that I don't follow day to day, but the headlines a couple of weeks back, or last month, I should say, more likely, caught my attention. And I thought, right, well, let's have a look at what the Elliott pattern would show in lumber. And we found some pretty interesting stuff in this particular chart, which is let's have a look here. That's the daily chart. Yeah, I haven't updated it since we forecast it down here. But one of the things that gave us a fantastic sell signal on this was the fact that we recognized the upswing back here was a double zigzag. And if you extend the first zigzag by 61.8, there's the target. Bang. Wow. So whether you look at the dollar index targets over, the longer term, or you take these price measurements, price ratio measurements, you're going to be able to really help yourself in determining where these trends are beginning, where they're ending, and the amplitude of the next movements, because you need to know when you put on a trade exactly what type of movement that you might get, so you can weight the amount of trade position that you're putting on.
Exactly. You want to wrap? Okay.
Yeah,
so
I was just going to show you the longer term lumber, but this has dropped 60% since then.
Yeah.
We're looking for a bit of a counter trend rally, but then another drop. So this is not quite finished yet this year.
Okay.
Yeah.
All right. And anything else you want? Perhaps the metals. A lot of interest in metals. Were you surprised, Peter, that just his Powell's jawboning, took the market down before, $100 in gold, a few dollars in silver, without even beginning to taper?
Yeah, well, I think normally the tapering, of course, would be very bearish for gold, but the gold price recently has dropped because of the dollar. That's all it is.
Okay.
You're just trading the dollar with gold. Let me just check where I've got gold, and we can take a look. Yeah, this is the gold chart, and
Okay.
yeah, I think notwithstanding the short-term picture. By the way, this chart is going in tonight's report. If anybody would like that, we'll tell you about it later. But the overall pattern on gold is moving down here into a very complex correction. It's a triple zigzag. First zigzag ends here, so you've got 3 price swings for that. Then you have a corrective rally, another one, another corrective rally, and we got a final one down to about 1600. And I think this is timing in with the dollar. So if you were going to invert this the opposite way around, this movement down here is the movement that we've seen in the dollar recently,
Right.
moving upwards.
Okay.
It's not quite finished to the upside, the dollar index, so therefore gold is not quite finished to the downside. If I just do that, that looks a bit like the dollar index.
Yeah.
So this one basically will have a bit of a flip up like this. Then you'll get some price regression, which is what we're looking for the dollar index, and then another big push later in the year. So that inverted would mean that we come down, rally a bit, and then come down here later in the year. So I think this is probably sometime in September, October time at least for gold before we end up buying it.
What a great review of what I'm going to call the Sir Isaac Newton phase of the markets, where people discover gravity does exist. All right,
Yeah.
so
yeah, that's more appropriate for Bitcoin, isn't it?
You want Bitcoin? That too. Gravity exists everywhere. Go ahead, Peter. Show your long-term count and let people have wet dreams about crypto.
Okay. Well, if that's what you desire, I can provide. No, it's I mean the crypto market is quite spectacular. I can show you our long-term target here is phenomenal. You know, that's it keeps getting raised, but I mean I think you can rely on probably 250 to 300,000 on this eventually. It sounds crazy, but we're using log scale to obviously correctly anticipate where these movements are coming from. But we're sort of tentatively buyers at the moment. There's a bit of downside risk that we've got to watch for. If anybody's trading crypto, watch for some.
You don't want to see it close under 30?
Yeah, I think this is a really key number, this 31,400 number today or tomorrow. We'd forecast it down over the last few days. It has come down. If it can hold that number and it starts to push back up, you need to be a buyer. But watch for that break here, this secondary break. That's really important. If it breaks below that 30,549 number, you'll have to jump out your long positions and wait for an attempt down to 26,378. That's down here. So
okay.
But basically, you know, if we go 6 months forward, or maybe a year forward, you know, the prices should be a lot higher than where they are today.
Okay. What a great review, Peter. So you proved to our listeners, our viewers, why I really appreciate your work. What's the best way for people to keep in touch with you, subscribe, follow your work, and perhaps choose you to help them navigate the narrative you've laid out here today?
Well, thanks. Yes, well, everybody, if you're really interested in some of the subject matter we've been talking about today, and we have lots of short-term trading ideas for you in the report. We publish twice a week. It's called the Elliott Wave Compass Report. I can just show you. Go to wavetrack.com up here, and then you can go to registration and subscription. If you just hit subscription, the first item is the Elliott Wave Compass Report. And the good thing about this is that if you're not sure about what the content's looking like and you want a trial or whatever, actually you can just subscribe for 1 month, and there's no automatic renewal for this. So it's $39. That means two big reports a week, and with added commentary. And I think that you know, you can just experiment for $39. It won't kill you, and hopefully we'll prove to you that we can actually call the shots for you on a consistent basis. And yeah, the report actually from a couple of days ago looks a bit like this, so you can see what it looks like. Here it is here. And yeah, we'd be happy for you if you could join us. Yeah.
So, Peter, thank you very much. I hope pips rain on you during this pause and reflation. And what's interesting about this is if you can accumulate some gains during this drawdown in multiple instruments, and you really build up a nice war chest, the next setup this fall for longs across the board with the dollar failing is going to be as phenomenal as the recent rally was from last April at the COVID lows.
Yes, well, if we are proven correct and we do get a fallout to the magnitude that we think, there's going to be some fantastic opportunities, really fantastic. I mean, we're already looking at buying some gold stocks, some individual gold equities. which will feature in the mid-year report. That should be ready within the next 3 or 4 trading days. And you can subscribe on the videos for those. By the way, if you want details about those, go back to WaveTrack, go back to the homepage, and keep a lookout on our blog section up here. If you go at the moment up here to Stock Indices Part 1 video series is already out. It's about a two-hour video, and you can get a PDF download with all the charts involved, and that's already in here. And Part 2 will be commodities, and the next thing to really buy, I think, will be the gold miners. So as soon as gold hits a low later this year, that's definitely going to be on our itinerary. You could see some really big multiple gains in gold stocks over the next.
I'll be backing up the truck, Peter. So thank you so much for sharing your work. And what's your most valuable currency, Peter?
The one in the bank, I guess.
Mine is time. Thanks for spending your most precious currency with us today, edifying the TradeGate Hub community and those that see this interview on FX Street. Really appreciate it, my trading warrior brother.
Thanks, Dale. I appreciate it too. Thanks for inviting me today, and God bless everyone. Thanks.
Adios, Peter Goodburn, and check out his newsletter. And I think that you have some nice long-term narrative ideas to make this a great year. Thanks again, Peter. Adios.
Ciao.